Did I mention that this is sponsored by the amazing programs on Building Your Wealth, link down below, and that 40% off coupon code that has been briefly extended? Yeah, it got extended a little bit, but don't worry, the price will go up as soon as this date comes up. Hey everyone, me Kevin here. In this video, I'm going to break down exactly what the Federal Reserve just said in their June meeting. They just released the notes for this. So let's go ahead and go through the Federal Reserve minutes. First, it's useful to note that right here, the Fed starts by talking about what projections are and expectations are for the Federal Reserve. It says here that median forecasts for 2022 and 2023 in terms of inflation each rose less than 0.1%, suggesting expectations for inflationary pressures might be beginning to subside. This is something that's worth noting, especially after the Federal Reserve has mentioned that data recently has shown lower employment growth and higher inflation readings than have been expected. So they're basically saying, hey, we were wrong. We saw a lot more inflation than was expected. However, going forward, we think we'll be right and there'll be less inflation. Whether 50% of you are going to believe them, 50% won't. But anyway, this was interesting. Take a look at this. Measures of expectations for Federal Reserve policy. So these are primary dealers and market participants who work with the Federal Reserve. They are surveyed by the Fed to see what the market thinks the Fed is going to do. And the Fed looks at those expectations like, aha, this is what y'all think we're going to do. Anyway, the market believes that the Federal Reserve is going to begin to taper in the first quarter of 2022. Taper is reducing bond purchases. Right now, Federal Reserve is buying $80 billion a month of treasuries and $40 billion a month of mortgage-backed securities. Later in this paper, you'll hear, or there's a section where the Federal Reserve members begin to discuss, hey, should we taper mortgage-backed securities because the housing market is a little potentially hot right now? Or should we taper treasuries along with it? And you kind of get this sort of back and forth discussion where you have Federal Reserve Board members suggesting, hey, maybe we should just taper both at the same time. And others say, no, just start with mortgage-backed securities. So there's really no cohesive answer in terms of what's going to get tapered first. But it's worth noting the expectations here, that the expectations are the first quarter of 2022 for the taper to begin. However, there is a note here that it would be reasonable to potentially see the taper to happen 1 quarter earlier or 1 quarter later. This means we would expect a taper to be announced sometime between Q4 2021 and Q2 of 2022. Worth noting. Okay, the participants also projected no increase in the target federal funds rate, so that interest rate, or a 1/4 of a percentage point increase by the end of 2023. So participants with the Fed really aren't seeing an increase to interest rates until the end of, or sometime during 2023, and maybe just one of them. If even at all. You've also got some talk here that banks are essentially trying to encourage their customers to stop depositing as much money. In other words, banks have too much cash. And this is something that we're seeing in the reverse repo market as well, where why are reverse repos so high right now? Why are we seeing those levels so high? It's because the banks right now have too much cash. We do have notes here that many participants remarked, however, that the economy was still far from achieving the committee's broad-based and inclusive maximum employment goal. Remember, maximum employment also includes minorities, so blacks and Hispanics get counted as well. This is very important because black and Hispanic unemployment is 8 to 9%, whereas white unemployment is in that mid 5.5 range. So you've got a big difference here. And that is evidenced by them saying that the market recovery continues to be uneven across the demographic and income groups, lower income, higher income, and of course, race. So then, some participants also judged that supply chain disruptions and labor shortages complicated the task of assessing progress towards the committee's goals. And so that, in other words, they're saying, hey, like, because we have all these temporary disruptions, it's actually kind of hard for us to determine, is the underlying economy getting better or not? Like, do we need to taper or not? Do we need to raise rates or not? They're basically saying they're not really sure yet, but that they do expect inflationary pressures to subside, which is kind of just basically them going, told you, we kind of think, yeah, all right, there was inflation. Like, we knew that inflation was coming. All right, it came in a little higher than expected. We still think it's going to go away and it's going to be temporary. This is kind of what this sounds like so far. And you also sort of have the Federal Reserve going, maybe we'll taper mortgage-backed securities, maybe we'll taper treasuries. Other people don't think we're going to do so until Q4 to Q2 2022, and we don't know either yet. So it's kind of right now not a lot of answers, just more sort of delay expected. Several other participants cautioned that downside risks to inflation remained because temporary price pressures might unwind faster than currently anticipated, and because the forces that held down inflation and inflation expectations during the previous economic expansion had not gone away. This was really interesting because they're basically saying, look, we were dealing with deflation before the pandemic. Sure, we've got temporary price pressures now, but if those go away, we still have those same underlying issues we had before. Technology from deflation causing deflation caused by technology, an aging population, right? These are all things that push prices down. Various participants mentioned that they expected conditions for beginning to reduce the pace of asset purchases, aka taper, to be met somewhat earlier than they had anticipated in previous meetings, which kind of leaves folks wondering, okay, does that mean Q4 to Q1? Who knows? Some participants saw incoming data as providing a less clear signal, though. See, and this is where they give you those mixed signals where it's like, maybe we go a little bit earlier, but no, we're just still not certain. They're pretty vague here. Various participants offered their views on the committee's MBS purchases. This is mortgage-backed securities. Again, commenting on the high real estate prices. Maybe they should be tapered first versus just treasury bonds or them in tandem. In addition, participants reiterated their intention to provide notice well in advance of an announcement to reduce the pace of purchases. So maybe in Q3, which is what we're in now, maybe towards the end, we'd hear something about Q4. And if we don't hear anything in Q4, then maybe that means we won't see a taper until 2022. Really, because they're still looking for that clarity, and they don't even have the answer themselves yet. Inflation has risen, largely reflecting transitory factors. Overall conditions remained accommodative. This was interesting. They judged that these asset purchases, the money printing they're doing basically, would help foster smooth market functioning and accommodative financial conditions, thereby supporting the flow of credit to households and businesses. And that's pretty much it. So bottom line, hey, the stock market isn't really reacting. 10-year treasury yields aren't really reacting. The market's just kind of like, okay. So in other words, you guys didn't really tell us anything because you still haven't figured it out. You're still determining what's going on in the market. You're still trying to determine, are there clear signals that say the market's overheating, or are the things that might feel like we're overheating just signals of temporary price pressures? And when those go away, maybe the underlying economy isn't actually as strong as we think it is, and that we will see slower growth and slower inflation. It's kind of interesting, something to keep an eye on, folks. Very interesting to me. Hopefully you found this insightful. If you did, consider subscribing for more content like this. And folks, we'll see you in the next video.